market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Nvidia has failed to impress investors with its latest sales forecast. The chip maker delivered a first quarter outlook that really easily beat the average Wall Street estimate, but it still faces uncertainty in China, and then there's a shortage of memory chips. Well, our Bloomberg intelligence analyst, Matt Bloxham, is here. Matt, so is it fair to say that these numbers were disappointing, or was it that we're just expecting too much?
Yeah, I mean, I think objectively, you couldn't really describe the numbers as disappointing because revenue was up kind of over 70%, and the forward guide points to a revenue growth of close to 80% at the top end of their range. But yeah, I think it's kind of the context is where expectations are at. I think when you see what the hyperscalers talked about in terms of capex for 2026 a few weeks back, totaling something like $650 billion to spend, I think nobody could have possibly expected anything other than a good print from Nvidia and a positive outlook, because there's a huge amount of near-term demand. The big question that remains unanswered is whether that's sustainable, because most of the demand today is coming from the big hyperscalers who are investing kind of speculatively almost in terms of the kind of AI-powered future. And if that kind of investment isn't backed up ultimately by enterprise demand for not just pilot AI but scaled AI, then the whole kind of outlook starts to kind of crumple. And there wasn't really anything that they could say yesterday to kind of shift investor optimism towards that kind of important next phase of the AI story.
So, if you look at the future, though, for Nvidia, they also said they had this license for the good chips, the H200s, and they can sell, a small amount to China.
Yeah.
Is that really significant?
No, I personally think that's a bit of a red herring. China is a red herring. I think for Nvidia now, given the geopolitical situation, China is clearly shifting its domestic technology companies to source from domestic suppliers, for example, Huawei, and I think that's going to continue. And I think really anybody that's kind of baking China revenue into their Nvidia profit projections is being overly optimistic.
So interesting, Matt, as always. Thank you so much, our Bloomberg intelligence analyst, Matt Bloxham. Now, Cuban forces have killed 4 people who opened fire with a speedboat with Florida identification tags. The Interior Ministry in Havana claims that the boat's occupants intended to fight against the government. Secretary of State Marco Rubio says the U.S. is investigating the shooting. Let's bring in Bloomberg's Washington Deputy Bureau Chief, Laura Davison. Laura, what do we know about the incident, and how significant could it be?
So we don't know much yet from the U.S. side. The Cuban government has come out and said that there were 10 individuals on this boat. They were armed and headed to go commit terrorism in Cuba. The boat was registered in Florida. The U.S. appears to be caught rather off guard by this. Secretary Rubio, Secretary of State, was asked about this and said that he was not going to comment until there could be an investigation from the U.S. side. This comes at a really auspicious moment, though, between U.S. and Cuba relations. Cuba itself is sort of on the precipice of economic collapse. There's been an oil embargo imposed by the U.S. since January, since the ouster of Maduro from Venezuela, which was Cuba's biggest benefactor. This is really, comes as, Trump has repeatedly said that, he wants to see the regime ousted within Cuba. He has not been specific about what kind of actions he might take, but hasn't ruled out military action, at least not yet.
Yeah, are we expecting a response from Washington?
We are. Rubio has said that the military, that intelligence forces are looking into this. We have not heard anything yet. Everyone has been very quiet, but expecting that there will be more on this in just the coming hours, if not days.
Laura, thank you so much. Bloomberg's Washington Deputy Bureau Chief, Laura Davison. Now, geopolitically, events and big tech are 2 of the big market stories today. And with us now is Greg Peters, Co-Chief Investment Officer at PGIM Fixed Income. Greg, I'm so excited to speak to you because there's everything and anything that could be market moving. But actually, my favorite phrase is the market is stuck in the mud. So you don't really know if we're risk off, risk on. What's it mean for fixed income?
Well, I think we're in a wait-and-see period. There's lots of talk. We were just talking about AI, and there's lots of strong opinions and views. And the truth is we're not really sure what the shape looks like over the medium and longer term. And so I think, we're very much, trying to figure it out, right? What we're seeing on the credit side is a clear revisitation of the software space. Anything AI related. That's been a big growth area in credit for quite some time. So you have that. And then you have the geopolitical side driving sovereign bond yields, you have debt and deficits. So you have a confluence of so many things going on. So we're stuck in the mud, but we're watching this mosaic of tremendous activity around us.
What happens to treasuries and dollars? So does the dollar weaken much further from here?
I think you have to have a short-term and a slightly longer-term view. The long-term view is, yes, I think the dollar is in a kind of a secular weaker mode here. Over the short term, the dollar, U.S. Treasuries are still very much of a safe haven status, right? You've seen it with the potential conflict in Iran, so it still has that attribute to it. But we're working through that cycle over time, and I think the question is 5 years forward, 7 years forward, will it have the same kind of efficacy around that risk-off hedge?
What are you expecting the Fed to do? There's so many unknowns because of tariffs and trade. Frankly, we don't know what happens after 150 days. We don't know actually what happens with, the tariffs or the taxes that were collected in the previous 8 months. Does that impact jobs or inflation, or are you looking more towards AI?
Well, I think, once again, it's a combination of everything. But I think what the Fed is looking at is wait and see. So I don't think there's any real reason to move today. I think they need to wait. It's clear that the labor market has been stagnating for a while. The data flow keeps moving up and down, but I think that's the trend. AI is a clear disruptor that has near-term inflationary implications, longer-term disinflationary. But I think we're in wait-and-see mode. More importantly, we have a tremendous amount of stimulus coming through in the U.S. fiscally. And there's a real push to kind of overheat this market heading into the midterm elections.
But so does that make it impossible, again, to cut, because inflation could be creeping back up if they needed to cut on the labor side? How much does it complicate things? Well,
it definitely complicates things, particularly given kind of the change in chair. President Trump has been quite vocal, of course, around wanting interest rates lower. Kevin Warsh is a known, more on the hawkish side, wants to trim the balance sheet, all those types of items, all else equal. That doesn't drive rates lower. The markets are really trying to figure that out. It is a paradox here, but I think the markets have given kind of Warsh a free pass. It doesn't see any real kind of move on the rate cutting cycle front. The market hasn't really priced in anything more than 2 cuts. And the balance sheet, I think, is for another day.
Greg, how would you describe the bond market over the last couple of weeks? Because there was, when I started out in this profession, there was a correlation between equities and bonds. And over the last 3 to 4 years, that's been pulled apart. But actually, they've behaved more like normal asset classes. And I don't know whether, what you think the underlying cause of that is, and whether we go back to older days.
Yeah, the past couple months or so, it's behaved like it has normally, typically. Right. So it has been that kind of risk-off, risk parity hedge. Leading up to this time frame, though, has been very volatile. And once again, the efficacy of that trade has really been quite poor. And that just creates more questions and confusions, actually. The fact that it's worked is great, but I still think there's a longer-term assessment of whether that holds true going forward. But yes, the bond market has done exactly what it's supposed to do. Yeah. It's traded as a safe haven. The curve is really flattened out, even though all roads point to steeper curves. That has frustrated investors like myself, but it's safe haven, it's risk-off type of behavior.
How has AI and how will AI actually impact bond markets? Is it impacting Treasury positioning?
I don't think it's impacting Treasury positioning per se. The real AI story is in the credit markets, right? So there's $5.3 trillion that needs to be financed over the next 5 years. That's a tremendous amount of debt. A lot of it's hitting the investment-grade corporate market. You've seen the deals come fast and furious this year. Over $32 billion year to date, just 20 from Alphabet or Google last week. Including the 100-year Sterling deal. So that's where the action is on the AI front. Haven't really seen any impact on the Treasury side.
But is there any way that you think bond investors should be reacting to it? Again, there's always a reaction function, right? We talked a little about inflation, is there like an AI play in fixed income away from credit now?
I think it's mostly in credit. I think it's cleaner. Yeah. Once again, you think about the impact on productivity and what that means. You're having this tremendous capital being put into the system right now. All else equal, that's inflationary. Over time, it's disinflationary. So, I think it's more of a step function type of move as far as rates are concerned. But all else equal, I think rates are a little too low here, given the growth, given the inflation, given the AI boom. But once again, it's being driven by factors like risk off and fears of Iran and those sorts of things.
Greg, JGBs. I mean, JGBs gave us a little bit of made our hearts race. What do you think long term? Where do you see the most value in Japan?
Yeah, so I mean, for years and years it's been dormant. There's been a dramatic repricing. They've been out of step with the rest of the world, right? So, what they found is that with government intervention for so long, they wound up with a broken bond market, right? There was no natural buyer for JGBs, right? And on top of it, you had the yen carry trade. So I think with yields moving higher in Japan, I think all else equal, that just sucks money out of the global system back into Japan, right? Those Japanese flows have been fast and furious for decades now, and that gets recycled back. I think that's the larger implications for the JGB move. I expect rates to continue to kind of move higher there. I expect the currency to continue to weaken as well, but I think we're caught in this cycle of readjustment that's long overdue.
What about Europe? I mean, overall, where do you find? I mean, what do you buy today to make money?
Yeah, so the good news about global fixed income is that the correlations are lighter today than they've been. Leading up to the past year and a half, it's been just a dollar proxy, treasury proxy trade with different betas attached to it. But you're seeing different inflation regimes, different growth regimes, different central bank pace in terms of adjustments. So the value is going global. Right. But, you look at the gilt market. The gilt market looks pretty attractive in here. There's a lot going on.
There's a lot going on, Greg. I mean, attractive, but also, again, not for the faint-hearted.
It's not, but it's 110 basis points, higher than France as an example. There's some things going on there as well. So the way we're thinking about it is the back end of the curve is much more treacherous, right? Because it's tied to factors that are way outside of your control. As you get closer to the central bank policy rate, so the belly of the curve and in, it's more controllable. Yeah. And so we like the steep curves. Fixed income does really well when curves are steep. So yields are high, all else equal. Curves are steep. It's a very good time to be in fixed income. And it's about roll and carry. So I'm not looking for massive change in yields or spreads. I'm looking for the roll and carry.
Greg, we have viewer questions. You're such a popular guest. We have many viewer questions. If we get 5 viewer questions, I'm going to give you a free espresso. Yeah. Okay, so this person's writing in saying, has a bond equity correlation broken down since COVID due to the tremendous amount of new debt created since then?
I mean, the debt dynamic is an interesting one because it doesn't matter till it matters. I still don't think it matters. Clearly, we're in an over-indebted world, but I think it has been in part due to that, right. But I don't think it's precisely due to that. What investors on the bond side really care about is the trajectory. Right? And so look at Japan as an example. So Japan has had the lowest interest rates globally with the highest debt to GDP. Right? So that's not the single factor. What investors focus on is really the trajectory and the stability of government. So I think that is a precondition. Higher debt to GDP is a precondition, but it's those other factors around trajectory, rule of law, FDI flows, and alike that drive it more. So I think it's part of the reason, but not the sole reason.
So interesting. Greg, so good to have you. Thank you so much for joining us. Greg Peters, Co-Chief Investment Officer at PGIM Fixed Income. Coming up, the Swiss chemicals giant Clariant meets sales estimates in the fourth quarter. We'll hear from the company's chief executive next, and this is Bloomberg. Well, the Swiss specialty chemicals company Clariant has reported sales that met estimates in the fourth quarter amid global market challenges. Well, we're now joined by the Clariant CEO, Conrad Keijzer. Mr. Keijzer, thank you so much for joining us. So will you reclaim, and we'll get to the earnings in a second and your outlook, but actually right now, will you reclaim any overpaid tariffs from the U.S. given the recent Supreme Court ruling?
Yeah, it is a very recent ruling. The Supreme Court has said the tariffs are illegal. That we know. We know that they're no longer in place since last Tuesday. That we also know. What we do not know yet is any procedure to reclaim tariffs. So we're expecting that clarity from the U.S. government in the weeks ahead of us.
Are your customers expecting the money back?
This is obviously one of the challenges we have. Our customers would expect these tariffs to be paid back because as a company overall last year, we by and large have been able to pass on these tariffs to our clients.
So have you gotten any guidance actually on this from the Swiss government? I know Switzerland has been so impacted and we're hearing more and more chief executives really trying to figure out what they should do next.
Yeah, we're trying to get clarity from the U.S. customs clearing agencies. This is primarily also about the new tariffs that are in place right now, the 10%, because we have products shipping in and out every day. We're trying to get that clarity from the customs clearance agencies in the U.S. I will say for us overall as a company, this is a manageable impact. We've indicated last year we have an annual run rate of roughly 20 million Swiss francs of tariffs that we're paying. By and large, we supply local for local. We have 68 factories globally. And in the U.S., we typically produce in the United States for the United States, but still about 20 million of tariffs that we paid last year. And like I said, by and large, we have passed this on to our customers.
How do you see overall the environment developing for chemicals in Europe?
Yeah, overall, the environment for chemicals in Europe still is challenging. If you look right now at the chemical industry in Europe, last year, production rates were still roughly 20% below the last year before Corona. Worldwide, chemical markets have recovered from Corona. In Europe, we're still 20% below. And the key reason for that is the energy price. So even at current gas prices, which are relatively low, again, around 30 euros per megawatt hour, that's still double the price of energy, double the price of gas from what we had previously with the cheap piped-in gas from Russia.
How's business going in China?
Business in China, we are seeing a slowdown. Last year, overall, if you look at chemical markets, China still showed growth, roughly 7% production volume growth. The expectation is for a slowdown. We do see a weaker sentiment right now. There has been a significant capacity built up specifically in chemicals in recent years. So markets are at the moment oversupplied. You see that primarily in commodity chemicals and petrochemicals. In specialty chemicals, we still actually see a good environment where we also see good margins for our products in China.
Mr. Keijzer, I mean, overall, your business seems to be performing well. The share price maybe hasn't been, quite catching up to your expectations. Are you frustrated by that? And what can you do to maybe align those matches?
Yeah, there is an overhang on the share price from ethylene litigation, which is a past legacy item. If you look at the operational performance of the company, it is actually the third consecutive year where we've increased our profitability. So last year, we finished the year at 17.8% EBITDA margin. That's an increase from 16% in the prior year, and that already was an increase from 14.6% in the year before. So we finished 3 years of consecutive profitability improvement, both in EBITDA margin as well as in absolute EBITDA. So for us, we focus on what we can control as management, as leadership in the company, and that is try to continue to outgrow our markets and increase profitability year on year, and that's what we've delivered.
Is any strategic move actually possible before litigation is resolved?
Yeah, we have a lot of liquidity. We have a very healthy balance sheet. We have a very strong cash generation. In fact, we increased our cash conversion debt to EBITDA from 30 to 40% last year. So we're well funded. And if there would be strategic opportunities, we definitely would like to pursue those. Our strategy is first and foremost about organic growth, margin improvement, but we certainly are open for bolt-on acquisitions like the Lucas Meyer acquisition that we did actually. Those are perfect fits, but we will be disciplined. We only would add companies that basically strengthen our core businesses that would deliver real synergies.
Yeah. How much money do you have to actually spend on acquisitions? How quickly do you think you could potentially make them? And is there anything that you'd be selling off?
Yeah, we have obviously a pipeline of targets. And if you look at those targets, they're typically smaller bolt-on deals, which also typically yield good synergy. None of these are capital constrained, so we have a healthy balance sheet. Our leverage has actually come down further last year. So we're in a good position to acquire companies if and when the opportunity would present itself.
If the sector is prone to consolidation, as you say, is there a danger, or actually do you think that U.S. and other foreign companies would come into Europe and buy some of our assets?
Yeah, if you look at the sector overall, we haven't seen a lot of M&A activity in recent years, but it's fair to say that if the outlook for growth is modest, and it is very modest right now, there is little or no growth right now, that historically always has triggered a wave of consolidation in the chemical industry. We are expecting that also actually in the coming years, that a level of consolidation will occur primarily in Europe, primarily in the US.
What's when you look at the next 5 years, again, what do you think is the most important chemical strand for Europe to keep? I don't know if any of some of the chemical companies are strategic for national security or even defense purposes, but how do you see that?
Yeah, well, I think it's a great question. The chemical industry is, per definition, very strategic. It is the mother of all industries. If you look around you in the room where you're sitting right now, Francine, roughly 95% of the products has some form of chemicals in them. So for Europe to have a competitive manufacturing base, it also requires a competitive chemical industry. You cannot make electric vehicles competitive if you're not also have all the chemical products that get into these cars competitively made within the region.
Mr. Keijzer, thank you so much for joining us. That was the Chief Executive of Clariant, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The world's most valuable company, Nvidia, easily tops expectations, but it's not enough to impress investors. The U.S. and Iran start a third round of indirect nuclear talks in Geneva, according to Iranian reports, with just days to go until President Trump's deadline for a deal. And Secretary of State Marco Rubio says the U.S. will investigate after Cuban forces killed 4 people who had opened fire from a speedboat with Florida tags. Now, the German Chancellor Friedrich Merz continues his first official visit to China today, with news Airbus is set to secure an order for 120 planes from the country. Now, the Chancellor has said he considers the main goal of his trip to get a better understanding of the Chinese President, Xi Jinping. Well, let's bring in our Chief Europe correspondent, Oliver Crook, and our Chief Asia correspondent, Ross Matheson. So thank you both for joining us. Ollie, has the trip been a success for, Chancellor Merz and importantly for Europe?
Yeah, I think as Chancellor Merz boards his plane, we understand he's about to do that to return to Berlin right about now. I think he can call this a victory in large part because there has been this sort of deliverable here potentially of these aircrafts, 120 Airbus aircraft. So obviously it's a joint company between Germany and France. So something that the Chancellor can come back to Europe saying that they have really won something. And this is sort of an interesting trip for the Chancellor of Germany. Germany has sat for a very, very long time, for many, many decades, very comfortably between the United States and China, basically being able able to play kind of both sides and having a very good relationship with both. It was the German auto industry that really developed the car sector within China back in the 1970s. What Germany has been contending with for the sort of last decade, or really the last decades, is actually the German model being adopted by the Chinese and them having a great deal of difficulty coping with that, whether it's the competition they now face in the Chinese markets around EVs, whether it's the competition they now face within Europe with some of these companies coming into Europe. And Chancellor Merz was there in China to basically have a conversation with Xi Jinping to tell him basically that there are, degrees to which the trade practices that China are practicing the Germans are not happy with, but they still do need to continue to build a sort of strong relationship. But Merz came into office talking more aggressively about de-risking from China, but as you can see on the board there right now, last year Germany did 252 billion euros worth of trade with China. It is now the biggest trading partner of China and Germany. That relationship was replaced by the United States, but ever since Trump sort of came into office, that is not something that the Germans can rely on anymore. So the difficult conversation that the Germans are having is being sort of stuck in these sort of frenemy situations in the East and the West between the United States and China, and trying to navigate both of those.
And Roz, I mean, China has hosted a number of world leaders, a number of European world leaders. So what are they trying to get out of everyone?
Well, China does like to maximise the opportunity, and having all these leaders come through is a chance to project themselves as being a good partner on the global stage, including when it comes to trade, and having these kind of conversations, including with the German leader. Of course, we just saw, his comments that he's expecting a further round of consultations between the governments later this year or early next year. That means the relationship, according to China, is on a different kind of footing, and to maximise those rifts that we're seeing between Europe and the US on trade. We're in this environment where for a lot of countries it's diversify or die. So everybody's trying to build different kinds of partnerships and trade relationships, and China is a key part of that, not just for the EU, but for a lot of countries around the world. And so for Xi Jinping, having all these leaders parade through China is a great moment for him to present himself both at home and on the global stage, and certainly, of course, building up to the big one, which is going to be his meeting coming in March with the US president.
Yeah, and Ollie, I mean, a lot of European leaders, including, Chancellor Merz, talk about not decoupling but de-risking from China. What does that look like, and is that even possible?
Yeah, I think that's something that Chancellor Merz was talking a lot more aggressively about in his election campaign in the early stages, and that was, of course, before Donald Trump was reelected as president of the United States. So I think the Germans were in a much more comfortable position once upon a time with a more sort of hawkish narrative around China, and you can kind of see that has eroded a little bit from the comments that we've heard from Chancellor Merz. Now, that being said, he says that the Germans should still continue to de-risk from China. However, he's not going quite as far as he did in the election campaign, where he was basically warning against German companies continuing to invest in China, saying that basically the government will not have your back, they will not bail you out, Germany will not bail out its own companies if something goes wrong in China. That is the kind of rhetoric that we've seen sort of abate a little bit, and we should say that German investment in China has reached the highest point that it has in the last 5 years. So to your point, your question about how sort of reasonable and how viable is it for these German companies to step back, it doesn't seem to be exceptionally so. The other concern that the Germans now have is, I'll give you an example of BYD within the European market, for example. Last year in January, BYD had market share in Europe of 0.7%. It now has almost 2% of all vehicle market share within Europe, and that is while it's still paying tariffs on importing goods. Now, in the next couple of months, BYD will have its own factory within the sort of tariff zone of the European Union in Hungary. That is going to pose an incredible challenge for some of these German companies. So again, just sort of illustrating all the different ways in which the relationship with China is very difficult for the Germans, to say nothing of the Chinese position on geopolitics in Ukraine and, of course, the issue of raw materials.
Yeah, and Roz, how are you expecting actually the relationship between President Xi and President Trump to evolve, especially when they're due to meet at the end of the month or at the end of March?
Well, that's going to be the interesting one. You know, we've had all these leaders come through. It's been really important for Xi Jinping's prestige at home, but Donald Trump is on a whole new level. And obviously the relationship is shifting quickly on the back of that Supreme Court ruling, which really weakened Donald Trump's ability to put heavy emergency trade penalties on China. So it's taken away some of his arsenal, some of his leverage, and China will be keen to see what they can do with that. You know, now will they demand different things from Donald Trump in return for continuing to send the US rare earths, for example? At the same time, they will want that meeting to go well. It's really important for China that meeting is seamless, it goes off without a hitch, there's no disasters, and that Donald Trump in a way comes away happy from it. So they'll have a vested interest in being quite muted perhaps in the run-up to the meeting. Hard to say what will happen in the minute, but you know, they want to show the US that they can be the bigger partner in all of this in a way. So it'll be very interesting to see those dynamics. But certainly things have shifted quite quickly in the aftermath of that court ruling.
Thank you both for joining us. Bloomberg's Chief Europe correspondent Oliver Crook and our Chief Asia correspondent Roz Matheson. Now, the European Bank for Reconstruction and Development is forecasting resilient growth in its regions despite ongoing trade tensions. Now, the EBRD's latest report comes as the U.S. Trade Representative Jameson Greer says President Trump will sign a directive raising global tariffs to 15% where appropriate. Well, joining us now is Beata Javorcik, the Chief Economist at the EBRD. Beata, as always, thank you so much for joining us. I mean, we're a little bit in limbo in terms of trade and tariffs because you're not 100% sure what can be reclaimed back, what happens next, how long does it last after the 150 days. So what kind of impact do you see it having on emerging markets?
Well, so far, when you look at new tariffs that were introduced last year, they did not have much impact on exports from emerging Europe, and that's because a lot of goods entered the U.S. market in the first quarter, prior to tariffs kicking in. So the effective tariff was actually below the statutory tariffs. But, you know, there is one underappreciated cost of these shocks to trade policy, and that's because they force policymakers to focus on the urgent, to operate in an emergency mode, and all the long-term challenges, such as competitiveness or dealing with aging, are being pushed down the priority list. And that's the real cost of those tariffs in terms of long-term growth.
I mean, when you look at, you know, a lot of the economies, everything has to do with dollar strength or dollar weakness in this case. How do you see that evolving?
You know, for the countries where we operate, for emerging Europe, what is the key is how the new development will affect Germany. Because really the impact of trade policy works primarily through the impact on the German economy, because that spills as demand from Germany for imports of both goods and services from the region. And it's not just supply chains, it's also consumer goods.
I know you work quite extensively on future plans for reconstruction of Ukraine. I mean, this week is the 4-year, I don't want to call it anniversary, but it's been 4 years since Russia tried to, you know, is invading Ukraine. So how, you know, can you reconstruct before the war is ended, or is everything just waiting on some kind of ceasefire?
Well, as an institution, we have been supporting Ukraine under war conditions, having deployed 2.9 billion euros last year. But of course, for the proper process of reconstruction to begin, you need a stable solution. No. And actually, when you consider 200 years of wars, what you see is that the success of reconstruction is actually not to be taken for granted. You know, in half of the cases, countries don't catch up with the pre-war trend quarter of a century later. And that's because peace is elusive, because wars tend to reignite.
Now, what do you see in Ukraine right now? Where do you need, you know, is it infrastructure? Is it energy? Is it other parts of the economy that need the most help?
At the moment, dealing with destruction of energy infrastructure is a top priority. That's where we have been focusing. But when you think about the phase of reconstruction, dealing with services, keeping basic services going will be the key to help people function, to bring the refugees back. Of course, improving institutions is a key priority. When the time for reconstruction comes, taxpayers in donor countries, we want to know that the money is being spent well. support for entrepreneurs, for small businesses will be the key. Even under war conditions, through our de-risking facilities, we have helped channel 3 billion euros to SMEs. So there are many needs that will need to be dealt with.
Beata, overall, when you look at, I had actually a pretty explosive panel at Munich Security Conference where the U.S. ambassador to NATO said that with one phone call, China could stop what's happening in Ukraine. And I know this was probably discussed also with, the chancellor over there in China. But does China benefit from Russia's oil market? Like, can you talk to how these economies have changed because of the war in Ukraine?
Well, look, there are linkages between the economies. Sanctions we as the Western world have imposed on Russia meant that European exports to Russia have dropped dramatically.
Yeah.
And that has created a vacuum in the market, and that vacuum has been filled by exports from China. But nevertheless, sanctions are working in a sense that we are depriving Russia access to knowledge, to technology embodied in our products.
So does that change? Does that change the Russian economy longer term?
Yes, this has an impact on productivity growth in Russia. There are critics who say sanctions are not working, but the real impact of sanction works through slowdown in productivity growth. It's just that this is something that's very hard to capture in statistics, year-to-year statistics.
So, there's again quite a lot of debate about a new sanctions package for Russia. Again, does that hurt the economy meaningfully, or is it longer term, which doesn't have an immediate impact on what happens in the war today?
Well, look, sanctions have multiple objectives. One of the objectives is to signaling commitment of sanctioning countries to create their support for the country they want to protect. Another objective is to hurt the country under sanctions. So sanctions tend to increase the cost of obtaining technology, the cost of imports. If you think about goods that were circumventing sanctions and still reaching the Russian markets, yes, that was happening, but it was only part of the flows that disappeared that was compensated for in that way. And those goods came at a higher price. So that was hurting the Russian economy.
But there are a number of countries also going through elections. I'm thinking of Hungary, a number of others, of course, in the regions that you cover. Is it too soon? Do we trust the polls? Is it, will it be a referendum on democracy or actually the economy?
Well, Hungary has been hit by the energy shock, by the slowdown in Germany, by weaker performance of the automotive sector. So certainly economic factors are going to play a strong role. Really, the growth in Hungary has been quite lackluster. And because Hungary did not have access to the EU funding, investment was much weaker. This year we expect a better performance of Central European economies, in part because the deadline for using EU function is looming. So everybody will want to tap into this EU fund. And that is increasing public investment. Under uncertainty, private investment is suffering. So public investment, infrastructure, European funds, defense is compensating.
Beata, thank you so much, as always, for joining us today. Beata Javorcik, the chief economist at the EBRD. Coming up, the U.S. and Iran head for a third round of negotiations today as the Trump administration levels new sanctions on Iran's missile program. We'll have more details on that next, and this is Bloomberg. Welcome back, everyone. Now, the Indian Prime Minister Narendra Modi has announced closer defense, trade and counterterrorism ties with Israel during a rare visit. Now, Modi told the Israeli parliament that the defense partnership is essential in today's uncertain world, and both sides are working to expand trade and investment. An Indian official told Bloomberg that Modi is also expected to finalize a major order for Israeli-made missile systems. Now, the U.S. Trade Representative says President Trump will sign a directive in the coming days, raising global tariffs to 15% where appropriate. Well, Jameson Greer also says the changes would not result in higher levies for trading partners that have negotiated lower tariffs, and that would include the EU and the UK.
So our goal with all of this is to have continuity. So we want to have the 10%, and we're looking about how to implement the 15% that the president indicated, because we want to have continuity. We want the countries, we want the companies, we want people to understand that what we were doing before, we're going to reconstruct with alternative tools, because we want to keep going, maintain the policy. We'll just have a change in the legal implementing authorities.
Well, the Ukrainian President Volodymyr Zelenskiy says he and U.S. President Donald Trump discussed preparations for a meeting between negotiators from their countries planned for today in Geneva, as well as further peace talks involving Russia. The conversation, which lasted 30 minutes, came a day after Ukraine marked 4 years since the start of Russia's full-scale invasion. Bloomberg understands that another round of U.S.-led trilateral talks may take place next week. And the U.S. and Iran are also to hold a third round of nuclear talks today in Geneva, with just days to go until President Trump's deadline for a deal. The Iranian foreign minister's spokesman said the negotiating team has a reasonable amount of flexibility in the talks. Well, joining us now is Bloomberg's Javorcik, anchor of Horizon's Middle East and Africa, and Paul Wallace, our managing editor for the Middle East and North Africa. So, Jumana, I mean, this is, again, a third round of nuclear talks. What are we actually expecting at the end of them?
Yeah, well, we got a little bit more color from the Secretary of State, Marco Rubio, overnight, and he said that the talks this time around will be centered around the nuclear program only. There was some speculation that perhaps the U.S. were pushing for a broader portfolio of subjects, including Iran's ballistic weapons arsenal. But for this round of negotiations, it seems like the conversation is going to really be focused on the nuclear program. And here is where a lot of the sticking points lie, because the U.S., undergoing a maximalist approach, have been pushing Iran for a zero enrichment policy. Iran have responded saying that they are entitled, as being a member to the NPT treaty, the Non-Proliferation Treaty, to a token level enrichment for civilian purposes. So we have to see whether there's going to be some leeway from the U.S.'s perspective on allowing for that quote-unquote token enrichment. Now, if they do go down that path, it would have to go alongside very stringent criteria, including, number one, allowing for full inspections from IAEA inspectors. As you know, when you were speaking to the Director General a couple of days ago, the inspectors have not had access to any of these nuclear sites since the June war last year. So number one, full inspections. Number two, actually handing over that enriched 400 kilo plus stockpile of enriched uranium, verifying its whereabouts and potentially moving it out of the country. And three, ensuring that Iran doesn't have those advanced centrifuges to start up the nuclear program again. So these would have to be some of the criteria that the U.S. are insisting on. And at the same time, from the Iranian perspective, they have said that they have flexibility with these negotiations, but equally, they're going to be pushing for concessions on sanctions. So we'll see whether the U.S. are willing to offer sanctions relief in exchange for Iran perhaps being more open to the other criteria when it comes to nuclear enrichment.
And Paul, I guess, you know, Trump has given Iran a very firm deadline between, he's given them 5 days, but between March 1st and 6th to strike a deal or threaten military action. I mean, are there pros and cons of military action? You hear from the U.S. side that actually could be very targeted. You kind of get the job done. I don't really understand what the end game from the U.S. is, and whether it could also get into something bigger that embroils more factions or some of the Gulf states, for example.
Exactly. I mean, I think it's undeniable that there are huge risks and huge complications for the U.S. if Trump decides to strike Iran. A limited strike, a strike that, is not aimed at, say, regime change and perhaps only lasts a night or 2 nights or something, is very different to an extended campaign over a month or something that is looking at regime change. And there are a huge number of doubts, even with the U.S., that regime is possible with an air and naval campaign alone. A lot of people just say it can't be done. It's important to realize that Iran has a high pain threshold. Iran can sustain losses in terms of both military personnel and civilians to a high level, probably a much higher level than anything the U.S. is willing to tolerate, or Israel. There is some thinking that if Iran drags this, if there are strikes and Iran drags the campaign out for a month, then the U.S. could ultimately be the loser, because that is not going to play well domestically with Trump.
Paul, we also understand that these, the nuclear capabilities are not easy to get to, right? They could be buried underground.
Yeah.
So again, do they know exactly where they're striking? I mean, I know we're not military experts, but it feels quite hard, actually.
Extremely hard. I mean, Trump said that the nuclear facilities that mattered had been obliterated at the end of the June war last year. He said that again and again. Now, there is some evidence, as we've reported today, that Iran is trying to sort of rebuild or reconstruct some of those facilities and sort of ensure that they're even better protected against airstrikes. It's incredibly difficult, and Iran can obviously lash out as it's promised to do. And, the most obvious thing that will happen is that oil will spike. You've got to ask yourself, does Donald Trump want oil spiking in a year of midterm elections?
And Juman, I mean, again, this is does Iran retaliate, and what happens to the Strait of Hormuz is probably the kind of, the day after questions.
Yep, no, absolutely. And to what Paul was just saying, it's really interesting, that article that we do have up on the terminal today, the satellite imagery of the reconstitution efforts that are underway with many of these nuclear reactors, facilities and centrifuges, which indicates that Iran not only has the capability, but also perhaps the willingness to restart the nuclear program should they not be thwarted. When it comes to the retaliation, they have said over the course of the last couple of weeks that if the U.S. strikes, they would not hold back in their response. And what we got back around the June war, the 12-day war last year, was a very telegraphed strike on the Al Udeid base in Qatar. But this time around, there's reason to believe that they would potentially go after other military assets in the region. They've even spoke of all of these assets potentially being a target. And don't forget that they are sitting on an immense stockpile also of drones, of these ballistic missiles that they will probably direct towards Israel as well. And speaking to our colleagues from the Israel Bureau, the country is on a high state of alert there, with the real possibility that we may see a restarting of attacks and counterattacks between Israel and Iran should the U.S. go down the military path. This would very unlikely be a situation where it would just be U.S. on Iran. Iran would likely retaliate, targeting some Israeli assets as well, infrastructure in Israel.
And Paul, again, I guess Iran's influence has diminished in recent years, on the oil market because of sanctions, limited foreign investment, but still accounts for 3% of global supply.
Exactly, and even if you just take exports, it's about half of that. It's about 1.5% of global production is Iranian exports. So it is important. And you could say, yes, the global market can probably absorb even an extreme scenario of Iran's exports going to zero. But could it absorb Iran lashing out by hitting Saudi or Qatari or Iraqi oil tankers and LNG tankers going through Hormuz? That is what Iran has effectively threatened to do if it feels that it's facing an existential crisis, a regime change type of operation from the U.S. Also,
an important fact I did not know: China is actually taking up 90% of all crude exports from Iran. Thank you both for joining us. Of course, Paul Wallace and Jumana Bursechi. Now, we have plenty more on Iran. We have plenty more on Nvidia. This is what the market is telling us about Nvidia. Look, some say it's a little bit unfair because Nvidia wasn't, it kind of beat by some metrics expectations. Maybe there's just too much hope on some of these big share prices. Nvidia now gaining some 1.7%. We'll have a full market roundup. We'll talk geopolitics, and we'll also talk about credit markets and software. Up next, Bloomberg Brief, and this is Bloomberg.